What if I told you that you probably pay a higher true tax rate than the wealthiest billionaires on the planet? It sounds rigged, and honestly, it kind of is. But they aren't using illegal offshore accounts or shady backroom deals to do it. They are using a completely legal playbook to bypass the IRS and build massive generational wealth. And the best part? You don't need to be a billionaire to use it. If you want to maximize your own wealth and keep the taxman out of your pockets, stick around, because I'm going to show you exactly how regular investors like us can steal their strategies. When you look at billionaires like Elon Musk or Mark Zuckerberg, you have to understand that they don't play the game the way we do. If they want a mega yacht or a private jet, they don't ask HR for a massive bonus. Why? Because high income means high income tax. Instead, they use a multi-layered strategy to make their taxable income disappear. Wealthy individuals take a low salary to avoid the top income tax rate of 37%, often literally $1 a year. By keeping their official paycheck near zero, they dodge heavy payroll taxes and high-bracket income taxes that most high-earning professionals have to pay. Instead of cash, they are compensated in company stock. This isn't taxed when they receive it or while it grows in value. They only owe money if they sell, allowing them to choose exactly when and if they want to trigger a tax bill. When they eventually do sell their stock, it is taxed as capital gains, usually 20%. This is nearly half the rate of the highest income tax bracket. This shift from wages to investments is the most effective way they lower their tax percentage. To get spending money without selling stock, they take out low-interest loans using their shares as collateral. Since a loan isn't income, it is completely tax-free. This allows them to fund a billionaire lifestyle while appearing poor on a tax return. The second secret formula is called buy, borrow, die. It sounds a little dramatic, but let's look at how it plays out in the real world. Now think about Bill Gates or Jeff Bezos. When they want to buy a mega yacht or fund a new venture, what do? Now that we know they get paid in stocks, would they sell massive chunks of their stock to buy the yacht? No, because selling triggers capital gains tax, and 20% is still too much for them. Instead, they go to step 2 of the playbook. They borrow. Here is how the 3 steps actually work. First, buy. The rich acquire appreciating assets. This could be real estate, business equity, or a massive stock portfolio. These assets grow over time, completely tax-free as long as they aren't sold. Second, borrow. When they need cash, they take out a loan and use their assets as collateral. The IRS does not view debt as income. So, if you borrow $10 million against your stock portfolio, you get $10 million in cash, entirely tax-free. Your investments stay untouched, continuing to compound and grow, often at a rate that easily outpaces the low interest rate of the loan. Third, die. When the wealthy eventually pass away, they leave those assets to their heirs. Because of a tax loophole called a step-up in basis, the IRS resets the taxable value of those assets to what they are worth on the day of inheritance, not the day they were originally bought. The heirs use a small portion of the inherited wealth to pay off the loan, and the rest is transferred completely tax-free. All of that growth over a lifetime, never taxed. Now, their third way to avoid taxes is using the extreme write-offs. Here is how the real estate loophole actually works. It relies on a concept called depreciation, which creates what accountants call a phantom loss. When a billionaire buys a $50 million apartment complex, the IRS acknowledges that the physical building is technically aging and breaking down over time. They push this exact same logic even further with their lifestyle assets, like private jets. To a billionaire, a $60 million Gulfstream isn't a luxury toy. It's a heavily subsidized business asset. Thanks to tax rules like bonus depreciation, they can often write off a massive percentage of the jet's purchase price in the very first year. Add in the cost of fuel, maintenance, and the flight crew, and it all becomes a tax-deductible business expense. As long as they can prove they are conducting business, even if that board meeting happens to be at a luxury ski resort in the Swiss Alps, they can use the jet to dramatically lower their overall taxable income. Fourth, they master the art of the ultimate wealth-shielding combo, tax loss harvesting. When the market takes a dive, billionaires don't panic, they go tax shopping. Let's say they made a massive profit selling off one company, but another investment in their portfolio is currently tanking. They will intentionally sell the losing asset to lock in that loss on paper. Why? Because the IRS lets them use that exact loss to cancel out the capital gains taxes they owe on their massive winner. They effectively wipe their tax bill clean, and then they often immediately reinvest that money into a similar asset to catch the market's recovery. It's essentially turning a bad investment into a highly strategic tax deduction. Finally, we reach the boss level of wealth protection: charitable foundations and complex trusts. Billionaires don't just leave their money in a regular account to get hammered by the 40% estate tax when they die. Instead, they funnel their wealth into private foundations. This gives them an immediate, massive tax deduction, but they still keep their family members on the board to control exactly how and where that money is spent. To pass wealth directly to their kids tax-free, they use alphabet soup trusts like GRATs, grantor retained annuity trusts, or SLATs, spousal lifetime access trusts. These legal wrappers allow them to freeze the value of their assets, move millions of dollars out of their taxable estate, and still maintain indirect access or control over the money while they are alive. By the time they pass away, the IRS can't touch it. Now, you might be thinking, that's great for them, but I don't have a private jet. You don't need one. You can run these exact same plays on a smaller scale to supercharge your own net worth. Strategy 1. Shift from income to capital gains. You might not be able to take a $1 salary at your day job, but you can shift how your wealth grows. Stop relying purely on your W-2. Start aggressively buying appreciating assets like stocks and crypto. And here's the key: hold them for over a year. When you hold investments long-term, you qualify for long-term capital gains tax rates, which are significantly lower than your ordinary income tax bracket. Strategy 2. The business and depreciation shield. Billionaires write off yachts. You can write off side hustles. If you operate an online art business, rent out a car on a sharing platform, or run a short-term rental property, you can set up pass-through entities like LLCs or S-Corp. This allows them to avoid double taxation, deduct legitimate business expenses, and use real estate depreciation to legally lower your overall taxable income. Strategy 3. Tax loss harvesting. You don't need a family office to do this. When the market dips, you can sell your underperforming stocks or crypto at a loss and use those losses to offset the taxes you owe on your profitable investments. Many modern brokerage accounts will even automate this for you. Strategy 4. The charitable hack. You don't need to fund a multi-million-dollar private foundation to get tax breaks. You can use a donor-advised fund, DAF. This allows you to contribute cash or appreciated stocks, get an immediate tax deduction for the current year, and then distribute the money to your favorite charities slowly over time. Strategy 5. Be your own bank and protect your estate. When you need cash for a big purchase, look into borrowing against your portfolio, like a HELOC or a margin loan, instead of selling your assets and triggering a tax bill. And finally, set up a basic trust. You might not need a complex billionaire tier SLAT, but a standard living trust ensures your wealth passes to your family smoothly, avoids costly probate courts, and sets your heirs up to take advantage of that tax-free step-up in basis. The rich understand that building wealth isn't just about how much you make, it's about how much you keep. Start treating your money like a billionaire treats theirs, and stop volunteering to pay more taxes than you legally have to. Remember, this is for education purpose only, not a legal advice. If you like the content and actually learned something, please drop a like and subscribe, and I will see you in the next one.